Hey everybody, Marty Missouri here. It's after hours on Thursday, June 8th, 2023. This is your end of week stock market snapshot. I'll be sending it to clients Friday morning. That'll be the Friday morning message, and then we'll get to work on our weekly deep economic / macro dive. Today we'll do the usual. We'll take a look at the S&P 500. We'll take a look at the ETF that tracks the NASDAQ 100. We will take a look at the VIX once again. Then I want to throw in the dollar. Then I want to throw in individual investor sentiment, which happens to be the chart you see there, but we're going to come back to that one. And then I want to end with just a snip from an analyst who I have a great deal of respect for on breadth and valuations. That'll just take a second. So without further ado, the S&P 500 daily chart, folks. We still have, these patterns going on that we've been flagging and pointing to for years now as they develop. And you notice that I draw lots of wedges. Obviously, it's not the only patterns that we pay attention to. You can see we had a triple top up here with a consolidation, double here. We had bear flags back here. But these wedge patterns are pretty high percentage signals, if you will. For us, when they correspond with bearish divergences on the two momentum indicators that we like, and that's the moving average convergence divergence and the relative strength index, and that's what we have. And we actually have these long divergences which suggest that the magnitude of a breakdown, if one comes, could be significant. And we do continue to expect another leg down in the bear market that ultimately pierces through the 3,500, and that's based on our recession call that we have on right here. The QQQ, the ETF that tracks the NASDAQ 100 index, remember we had this rising wedge pattern developing here out of this channel, broke down below that as expected. We had burned through the short-term bearish divergences, but we got into overbought territory, and we had these longer divergences here as well. It makes a lot of sense to come back the very next day and test the uptrend line and any other resistance that we can draw across this pattern as well. And you can see how normal that is when we break out of these things right here. August, where we really broke down ultimately with some force. We had a rising wedge pattern, broke out of it, came right back, tested where we were the day before, and then finally fell out of bed. And we had this kind of flagging down as we went that just continued to work its way down until finally it bottomed, and it bottomed back when we were drawing this bullish pattern right here, right? Falling wedge with rising divergences. And right now, folks, we have something that looks more like this August peak up here than it does this October bottom, and for sure, in fact, everything's pretty much turned upside down. Does it mean the market's going to come correcting down? No, of course not. Does it mean that odds favor that? Yeah, of course it does. The VIX, nothing really changing other than continues to move further down into this bullish falling wedge pattern against bullish divergences. A few more days of this, though, and we'll burn through this technical pattern, and it won't be bullish any longer. But this jives perfectly with what I just showed you on the NASDAQ and the S&P 500. A breakout above on the VIX would correspond, I'm certain, with a breakdown below the rising wedges on the S&P and on the Qs. And it was Monday or Tuesday I shared the intro to a pretty robust report that we do each month on an index that we created back in August of 2021 that takes 12 indicators that we think are key signals or key representations of conditions related to the equity market, particularly the U.S. equity market. So we call it our Equity Market Conditions Index. These are data that we've tracked for years and have found significance in and some reliability in, and just put them together like we have our economic index as something we formalize internally, and it just helps us do what we do in terms of managing risk. Well, I mentioned that we had a couple of things that had actually improved month over month. We still have a very negative score, but the two that improved were the dollar and Fed policy. They both went from negative to neutral. So the dollar the previous month was negative because we had a very bullish looking pattern. So as we came into May, we were showing this downtrend line, right, with bullish divergences. Pretty bullish look here. So that I viewed as bearish for stocks because of the negative correlation that currently prevails between the dollar and the U.S. equity market. And sure enough, we got that bounce in the dollar, just as the pattern would suggest we would. The S&P 500 actually didn't fall during the month. It was actually up about a quarter point. The S&P 500 equal weight, which is really the broad market, all things equal, was down 3.5%. So it got really ugly as the dollar rose in the month of May. Well, as we got to the end of May, now we have a bearish rising wedge pattern, and we had our momentum indicators now rolling over. Sell signal today in the dollar. And sure enough, we had a good day in the market today. So this was bullish for stocks. And the dollar was down a ton. A 0.8% decline in a currency is a lot in one trading day. So that, again, amid an overall very negative condition score, the dollar setup was bearish dollar, bullish stocks. And today just confirmed that that correlation is there. And we saw gold rally. We had a really good day in gold and silver in our core portfolio. And then lastly, in terms of the charts that I drew up for you here today, mentioned here recently over the last week or two that we're beginning to see a shift in sentiment. I've explained this multiple times over the last few years, and I explained it here within the last week, so I don't need to get deeply into why this is the case, but just know that when everybody's piled up on the bear side of the boat, it's really hard for the boat to sink. There's a lot of potential underlying buying to happen there, if you will. Conversely, when everybody moves to the bull side of the boat, that's where things get dangerous. You lose that underlying support, and you can get a lot of people jumping ship or rushing over to the other side of the boat all at once. Here is the entirety of the bear market so far, where the market peaked here, right just basically after the turn of the year into 2022. So right there is the all-time high for the market, right? Here's where it bottomed. And notice the green line is individual investors, according to the American Association of Individual Investors, bulls among their members, right? The red is the bears. Okay, so again, this is that contrary indicator. Notice right at the all-time peak, the bulls were ramping up and the bears were leaving the scene. They were running over to that bull side of the boat, right? And ironically, the market topped right there, okay? Then we came back and rallied just long enough for the weight to move to the bull side of the boat, right? Right before the market came down a ton, right? And here we didn't cross over, but we peaked right here. You can see they were threatening to meet in the middle there, right when the market topped right there again. Same thing here, big top right here down to the so far low in the bear market. Here we got really close and really didn't roll over, right? Here we got really close. Within a couple of weeks of a little bit of a correction right in there, right? And then here, right, none of these signals work every time here. Got close, but no, we did not roll over. The bulls were right to be bullish, right? But right in here where we crossed over again, boom, pretty good correction. In here, got really, really close, but really didn't roll over. Had a few days that got volatile to the downside. And here we just kind of keep melting up, but look at this, folks. This is a rapid rush to the bull side of the boat and an exiting of the bear side of the boat. So this is what we've been seeing coming. And this actually thins the underlying support for the market. So this is something that we really need to be paying attention right here to. I believe it was in the midweek snapshot I read from Investor Intelligence Advisor Survey, and it's getting really close to that caution zone or danger zone in terms of bullishness there as well. So again, this makes for a riskier setup going forward. And then last but not least, Vincent Deluard, StoneX, like him a lot. Don't necessarily agree with him right now in his macro thesis, but still, really thoughtful guy, really, really smart. The largest U.S. stocks, the largest 5, account for 21% of total market cap. The same level reached during the peak of the 2021 bubble, which is right here, right? That's what I was talking about in terms of the peak. They also now trade at 38 times earnings versus a long-term trend of 21.5 earnings. Either we have a massive stock bubble or a massive antitrust problem. So obviously, he doesn't see a recession coming like we do, but he does recognize the very narrow breadth and the very problematic valuations, which aren't good timing tools, but historically forward returns coming off of these levels aren't good for the market over an extended period of time. And in our equity market conditions index, we track 5 valuation metrics, and they're all not good right here for U.S. equities. Time will tell. We remain open to all possibilities, and we'll report to you on what we see as things evolve going forward. Folks, thank you as always for watching and listening. Talk to you soon. Bye-bye.